Welcome to Investors Guide. You're watching ET Now. Thank you for tuning in. This is the show that helps you find all of the investment products in the market by looking at what suits your needs best. And what suits your needs best right now are avoiding taxes. Remember, any money you save on tax is money that you've earned. And if you watch the show on a regular basis, you know that I reminded you in the beginning of the year, in April. I reminded you again in September, and it's now December. So if you haven't made your tax-saving investments right now, you're going to be in trouble in about a month or so. What you need to do is start today. Over the course of the show, we will review tax-saving investments and tell you which ones you should be investing in. We'll particularly review an ELSS and tell you which one you should look at. And of course, you can write to us. Email ID is at the bottom of your screen, and send in any question you have about saving taxes. Let's get straight to this. We'll start the show by helping a young parent plan for their daughter's education. In our product review, we look at the ICICI Prudential Tax Plan. And if you're unhappy with your insurance policy, we'll find out the best way to discontinue premium and not lose any money in the process. All right, let me bring in Dhirendra Kumar, the CEO of Value Research and our in-house mutual fund expert who joins us every week. Dhirendra, thank you so much for joining us. Let's get straight to our portfolio question. Well, Mahendra Kadam has written in, Dhirendra, he's a young man and he takes home a monthly income of 15,000 rupees. He tells us he has expenses of about 9,000 rupees every month. He also has an LIC policy for which he's paying about 6,000 rupees a year. Now, he doesn't have any loans, and the only goal he has right now is to provide for his young daughter, who's only 5 months old. He wants to put some money aside for both her education and for her wedding in the future. And he tells us he can put aside 4,000 rupees every month. So he obviously has at least 18 years to plan this out, Dhirendra. But at 4,000 rupees a month, where would you like him to invest that money?
Ideally, for an investor like him, and he has a very well articulated goal and reasonably good time in hand. So I would give him a slightly different approach, which is very important. So I would say that he should approach for the first 2-3 years, even though there is plenty of time in hand, but he will not be able to withstand the volatility the moment he gets started with a completely market linked and aggressive investment. So I would say that next 3 years he should be into a balanced fund, and in this period he will be able to get sensitized or experience the market linked investment, though conservatively. And after that he should consider moving his money, all the accumulation in the balanced fund, into a diversified equity fund or a multi-cap fund.
Well, Dhirendra, if you want him to start with a balanced fund, can you give him the names of a couple of balanced funds he can choose from?
Yes, he should consider the ICICI Prudential Balanced Advantage or the Birla Sun Life 95 fund, and he should choose one of these two, and he will get all the advantages and with reasonable stability to begin with.
All right, on your screen right now are balanced funds that Dhirendra recommends for you. And of course, you haven't mentioned an emergency fund or health insurance in your question, and that causes me a certain amount of concern, especially with a young child. You should get health insurance for the entire family, for your wife as well, and make sure you set aside some money for emergencies. Let's move on to our next question. Well, 24-year-old Krishna has written in, Dhirendra, he saves 5,000 rupees a month and he wants to put this aside for long-term wealth, and he's also open to taking some risk. Now, what he's done is that he's made a list of funds he wants to invest in, and he'd like your approval on this list. The list has the ICICI Prudential US Blue Chip Equity, Kotak Global Emerging Market, DSP BlackRock Top 100, Franklin Dynamic PE, and the Franklin India Blue Chip Fund. Now, this is quite a long list for only 5,000 rupees. Are you happy with that list? Would you like him to make any changes?
No, for somebody who is admitting that he can assume risk, he has all the time in hand needed for a long-term investment. I think he has been very conservative with his investment. I think he has chosen good funds, but not necessarily the appropriate fund given the way he has explained himself. For example, I would say that if frankly FT Dynamic P ratio fund is a fairly conservative fund. It is more focused in terms of how not to lose money than to maximize gain, which given his time frame and his risk appetite, that should be his focus. Likewise, Franklin India Blue Chip and DSP BlackRock Top 100 are large cap funds, and they look impressive right now, but the performance of these various categories look very different. I think if you look at a long time frame, 5 year, 10 year, 15 year, the multi-caps and the small and mid-caps will certainly, be able to beat the large caps by a wide margin. I would say that he should approach it a little differently. Maybe he should consider our aggressive portfolio.
All right, so there you have it on your screen right now, our funds that Dhirendra is recommending for you that you should be investing in. Before we go into break, we know that we've been talking about inflation index bonds for a while on this show. You'll remember we had a discussion in July. We talked about how linking it to the WPI was not the most effective way to really beat inflation. The RBI has now sent out a circular talking about a new version of these inflation bonds. Take a look at the changes and how it will help you beat inflation when they do come in.
As investors, we have very few investments to hedge against inflation. Traditionally, we end up using gold and real estate to ensure that our investments are not eroded by inflation. Well, there is good news for all the savers out there. RBI plans to launch the much-awaited CPI index bonds in December. Let's take a look at some of the features of these bonds. The biggest advantage that these bonds offer is that they will be more effective at beating inflation than the WPI index bonds, which were announced earlier in May. Experts consider CPI as a better indicator of real inflation that affects you and me. The bonds have two components of interest. One linked to the movement of consumer price inflation, which will be calculated with a 3-month lag, and the other is the real rate of 1.5%. The interest will be compounded on a half-yearly basis. Simply put, one part of your interest will be variable based on the inflation rates and the other fixed at 1.5% annually. Here is an example of how the bonds work. Suppose you invested 10,000 rupees in December 2013. The first coupon payment is 6 months later, in June 2014. To calculate the inflation index which will be used will be of 3 months earlier, so March 2014. The average inflation for 2012 stands at 9.30%. Let us use that as the inflation rate. So the interest paid out will be inflation at 9.30% plus the real rate of 0.75%, which equals to 10.05%. The interest rate will be calculated using the inflation number 3 months prior. Suppose the inflation rate remains constant at 9.30%. So the interest paid out will be inflation at 9.30% plus the real rate 0.75%, which equals to 10.05%. We can see here that in the last 1 year, you have got an effective return of 12,111 rupees on the 10,000 rupees invested, which is 21.11%. The interest on these bonds, unlike the ones announced in May, is cumulative. That means there will be no interest paid out. Interest will be paid along with principal only on maturity. The bonds will be issued for a tenure of 10 years. The investor will be allowed early redemption after 1 year in case of senior citizens and 3 years for others. Experts are recommending these bonds to investors who do not need the cash flow in the next few years. The bonds can be a small part of a long-term portfolio, helping you protect your investments from inflation.
All right, coming up after the break, Dhirendra Kumar is going to stay with us. We'll talk about the ICICI Prudential Tax Plan. We'll find out if that's the plan you should be using this year. We're running out of time on those tax investments. Don't go anywhere. Welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us. It's time for our product review. And this week we're looking at the ICICI Prudential Tax Plan. Remember, we're already in December, which gives you only a few months to make those tax investments. So if you haven't done them so far, now is the time to do it. Avan is going to give us an introduction into that fund, and then we'll come back and talk to Dhirendra about it.
Thanks for that, Faye. Well, launched in February 2006, the ICICI Prudential Tax Plan has had a stellar track record, which proves it can deliver, especially when the market is rallying. Investors with a long-term horizon should consider this fund, but keep in mind the fund's high exposure to mid and small caps, which does make it vulnerable to volatility in the short term. For example, the fund's strongest returns were in the bull run of 2009, when the fund returned over 100%. But in the bear run of 2008, the fund suffered some heavy losses, falling over 50%. In comparison to the rest of its category, the fund has stayed in the top 10 for over a decade, beating its benchmark consistently since its launch. Even though this fund has had a 3-year lock-in that comes with every tax saver, it might make sense for investors to be prepared to stay invested after the lock-in expires to allow the fund to really work for you. Let's do some math to give you a better perspective. If you invested 1,000 rupees in this fund, you would have 16,789 rupees today. So should you be invested in this fund or pull your money out? Our experts are here to give you the answer. With that, it's back to you, Faye.
Alright, Avan, thank you for that introduction. Dhirendra, ICICI Prudential Tax Plan has been a 5-star fund for a very long time. But I want to ask you about the higher mid and small cap allocation that this fund has. It's a little aggressive. It tends to fall a little bit during bear runs as well. What sort of caution should investors have when they're investing in this fund?
No, I think, despite all the kind of decline that it has seen, ever since 2009, this fund has been able to consistently beat the market on by a wide margin. And looking at the portfolio, a portfolio of about 61, a little over 60 stocks often. And this is very well diversified. It does not concentrate, and it's a very high quality portfolio. I never come across an unknown name in the portfolio. And it's a good mix of, growth, value, or, sometimes a very opportunistic position, but never a big compromise on quality. So that way, I think, this fund has made a very great impression in the last 4 or 5 years.
Dhirendra, for someone who's looking to make a tax-saving investment this year, over the next 3 months, although they are starting late, is the ICICI Prudential Tax Plan an option for them?
Yes, it is an excellent choice, and it is worth considering. Averaging it over the last 9 months would have been beneficial. Nevertheless, it's a good time to be investing in your tax, making your tax-saving investment, and this is a worthwhile fund.
Finally, Dhirendra, this fund has 5 stars on your website. What would you rate it on the show?
This is a 5-star fund, and it is for just the right reason, just the right combination, which is despite assuming risk on statistically it shows, relatively lower risk and reasonably high return. So this is a worthwhile fund worth investing. 5
stars for the ICICI Prudential Tax Plan on Investors Guide, and over the next couple of weeks we're going to continue to review tax plans to help you make those tax investments this month so you don't wait any longer. Let's move on to our hold or sell segment. Well, Saptarshi has written in, Dhirendra, he's 37 years old. He's been investing a monthly amount of 25,000 rupees with a 15-year time horizon. He wants to know if his portfolio is on track to create long-term wealth. Right on top is the UTI Opportunities Fund. Should he continue this investment?
Yes, he should continue this investment.
Well, the Reliance Equity Opportunities is next on his list. Dhirendra, continue with that investment as well?
Yeah, continue with this investment as well. It is one of the impressive equity fund from Reliance Mutual Fund.
Birla Sun Life MNC also on his list, investing 5,000 rupees a month. Continue with this one as well. Does he need an MNC fund? Is there a need to be that specific?
No, this fund has done very well. This has been an outstanding fund, but this has been an outstanding fund primarily because of, its tilt towards pharma and FMCG. And from that standpoint, and last 3-4 years, the way these two sectors have been in prominence, that has driven the performance. When you are investing for very, very long term, then you should try and avoid as many portfolios which is constrained on diversity. And this fund is. In a changed market, this fund will struggle, as it did in the phase 2004 to 2008.
The Motilal Oswal Most Shares Nasdaq is the next on his list, Dhirendra. This is an impressive fund. You've recommended it a few times on the show as well. Would you recommend he continues investing?
Yes, I would say that he should continue investing in this. And this is a fairly aggressive US fund in a sense that it is so heavily tilted Nasdaq 100, where technology companies dominate, and this portfolio technology dominates substantially.
Last on his list is the FT Feeder Opportunities US Fund, Dhirendra. Now, given the fact that with the two funds, there are 10,000 rupees out of his 25,000 rupees going overseas into global markets, and these are impressive funds, are you comfortable with that allocation? Would you like him to continue investing in these funds?
Yeah, I'm not very uncomfortable with his 40% money going abroad. and that too in very high quality fund. Of course, he should have the understanding, and if he is drawn to these two funds because they have done very well in recent past, he is carrying a wrong message. He has to be ready for upheavals. What we have seen with these two funds, that they are the outstanding fund in the Indian fund universe simply because the rupee depreciated.
He also wants to know if he should add maybe the ICICI Prudential Discovery, SBI Emerging Business and SBI FMCG fund to this portfolio. I know your response to the FMCG fund is already no, but given the other two funds, Dhirendra, would you like him to add anything to this portfolio?
Yes, I would say that both the funds are worth adding, and it will not be a compromise on diversification. And these will be two finest funds from two fund families of which he has no other fund. He can well substitute his Birla MNC fund by these two funds, and they should be smaller allocation as well because they are mid-cap funds.
All right, so there you have it. Dhirendra giving you a thumbs up for your portfolio there. You can write back to us if you have any more questions. We have a question that's come in from Neville, who's written in, Dhirendra. He tells us he's a conservative investor. He wants to know if the HDFC Prudence Fund through SIPs will suit a conservative investor. And I want to answer this question also for all of our viewers who are holding HDFC Prudence in their portfolio. The HDFC equity group of funds have had a rough year. But as far as this fund is concerned, Dhirendra, would you like us to hold on to it, and does it make sense for a conservative viewer?
This fund has been, a blockbuster if we look at the performance till 2008, 2009. But when it comes to the equity allocation, it is dominantly into, it's a mid-cap fund, the 70% of it. That is something which conservative investors are not used to. So from that standpoint, it has proved to be a disastrous thing. Stability with growth from a balanced fund, this may not be the finest choice, though it delivers more return. But for great return, you should choose a great equity fund, not a balanced fund.
But if he does want stable returns from a balanced fund, Dhirendra, what fund would you recommend he invests in?
I would say that a fund which has a more moderate approach to its equity allocation. What is part of our stable growth portfolio, ICICI Prudential Balanced Advantage, or Birla Sun Life 95 or Canara Robeco Balanced, one should consider one of these.
All right, on your screen right now are balanced funds that would suit a conservative investor. We hope that helps. That brings us to the end of this segment. Dhirendra, thank you so much for joining us and answering all of our questions. If you have a question for Dhirendra Kumar, write to us on the email ID that's at the bottom of your screen. Coming up after the break, we'll tell you if it's wise to stop paying the premiums on your ULIP plans if you think they're not giving you returns. Don't go anywhere. Welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us. It's time for me to bring in Anil Sehgal, who's our insurance expert, to answer all of the questions you sent in on your insurance policies. Anil, thank you for joining us.
Thank you.
Our first question comes in from Nirav, who writes in saying he just got married and he wants to buy a term cover for at least 1 crore rupees. But the problem is he already has 2 policies that are running right now. He has 2 Jeevan Anand policies and he's paying a very hefty premium for only a sum assured of 4 lakh rupees. Now he wants to stop these policies and buy a term plan for 1 crore rupees, but he wants to know what the best process is really to stop paying the premium on his existing plans and what he should do about them.
Nirav, you have got Jeevan Anand policies which are traditional plans. Now in a traditional plan, typically the discontinuation or surrender penalty is effectively 30% of your, so the guaranteed payment to you is 30% of the premiums that you have paid less the first year's premium. So there is, the policy premium can vary and you should check with LIC in terms of what the penalty will be in your particular case, because that amount can change. Having said which, you need to also consider that if you want to make the policy paid up, the same discontinuation charge will apply. The remaining policy value which will remain will be used to make the policy paid up, which means that the sum assured would continue and the mortality charges will continue to be deducted from the paid up value till the amount becomes 0. So it will continue till then. So you have a cost. You have a cost of discontinuation which you should consider. And it may be worth your while after considering that to actually continue the policies for time being. till the surrender penalty reduces. Now, as far as the term plan is concerned, you should certainly consider taking a term plan, and a non-time term plan is the cheapest option for you. There are various options available in the market. Consider those for your age and for a 1 crore rupee sum assured. Typically, the sum assured should be, total sum assured on your life insurance should be 10 times to 15 times your annual salary. So whatever that amount comes to, you can look at that various options from the Aegon Religare item, the Aviva Life. You've got various other options available in the market. Go online, compare them, and take a decision.
Time for one last question. Rohit writes in. Now, he tells us he has a health cover from his employer and his dad has a health cover from his employer as well. But he wants to buy health insurance for his entire family. So for him, his wife, a child that they plan to add to their family in the future, and his parents who are both above the age of 60. He wants to know what is the best way to buy a health insurance policy for all of them, so they each have a cover of 3 lakh rupees. Anil, would you recommend the use of family floater, or does it make more sense than for him to just buy individual policies for everyone?
Rohit, you should consider a family floater plan for yourself, your wife and child. For your parents, you should consider whether it may be better off for you, given your father already has a Mediclaim policy, to top up that policy and take a higher sum assured on that, given the fact that the waiting periods will not apply. Otherwise, you might have to take 2 family floater plans, one for yourself, your wife and child, and one for your parents, because typically family floater plans will only cover 2 adults. However, the Max Bupa Family First plan does cover the whole family, and you could consider that as well, subject to, of course, cost based on sum assured that you want to take. The minimum sum assured that the Max Bupa plan has is 2 lakh rupees, which is in line with what other plans also have. And you should consider based on the premiums and other services that are offered within those plans.
Alright, so that's a wrap on Investor's Guide this week. Remember, you can write to us if you have any questions at all about your money, especially if it has to do with tax saving. Write to us before you run out of time, and it will be our pleasure to help you on this show. You can find a copy of this show on our Facebook page. You can reach me personally on Twitter. Thanks so much for watching.